Hey folks, coming at you for a short update from the Short Vol Show live coming up right now on YouTube. Hi folks, how are we doing today? Sunday afternoon. I just want to check in. Had a really productive week trading last week, and I had both sides. I had a loser and a winner or two, and I just want to go over them quickly. Big stuff coming up for the channel in the very near future. Let me just make sure my sound is good here, and it sounds okay. Okay, so it's kind of a well-publicized trade. This Stock W Wayfair, they make like, I guess, home goods. Everybody seems to know about it. I was looking at it. I found out about it because it came up on one of those screeners saying like biggest straddles of the week. And right before earnings came out, it was trading about 117, and it was publicized that the straddle was huge. And so I looked at it because I'm attracted to volatility. And here's the chart next to me. And I looked at the straddle and I said, I don't know which way this is going to go. How would I know? And so I kind of watched it, and on earnings, it gapped way up. And so I did this play where I thought that it might retrace a little bit, come a little bit back down. And so I sold this call spread, and over the next couple of days, it just continued to go higher. And so, on the initial move, I didn't make or lose anything because I didn't have a position on, but this is the chart behind me of the next couple of days, and it just went like up, 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 up. So Thursday, I just gave up, covered my position for a loss, and it was a bummer, because it just totally went against me and went straight against me very quickly. So that was a bummer on that one. Another position I did was for earnings was Foot Locker, and Foot Locker, this is what I would have liked to have happened with W. Freaking gaps up before the opens, and then it just kind of fades back a ways, comes back in a little bit. And that's kind of what the kind of action I was looking for in W. But in this one, I had a totally different position on. And what I did was I bought a calendar spread. And, right before earnings, the option volatility is quite a bit higher than it is now. Usually right before earnings, volatility is pretty high, and typically the front week, the options that are most affected by the earnings, or the front week, whatever is the closest to expiration of the earnings, it's kind of like the Price is Right. Closest options to earnings without going over them is cranked the most, and I think this was like, with 2 days to go, it was like something like, 100 and something volatility. And then the second week was high as well. It was like 70 something volatility. And so I was able to find one of the weeklies, though, as you looked out, like the 3rd April weekly was lower volatility than all the other weeklies. It was like 44 vol, whereas the other weeklies were in the 50s, 60s. And so I was able to kind of craft a spread where I was buying one of the 60 level puts. If we look at the chart here, stock was around 60, around 60 pre-earnings. It was like 59 something or other, or 58. Yeah, 58, 59. And so I started to look at these calendar spreads, and I saw that I could buy an April 60 put and sell now I didn't do the front week was like 1 day till expiration. I didn't do that, but I did the next options out, which currently now has 5 days to expiration, and I sold the 60 put here. So it was paying like $3 and 50 cents for the April, and selling this March one for like $3. And the reason I mention the handle of $3 is because that's kind of significant in our calculation here. Now, anytime we buy a calendar spread, it gets us long Vega. So what that means is that essentially, if volatility comes in, we should theoretically lose money. Now, what offsets that though is that I'm buying a low volatility. I'm buying like a 44 volatility, and I'm selling a higher one against it. In this case, I think it was like a 75 volatility. So the question is, it's kind of a complicated trade. It doesn't sound that complicated, but it's kind of complicated because there's a couple things going on here. You've got the volatility of the whole trade as a whole package. You're long Vega, so you got that going against you because you know pretty much for sure that once earnings come out, volatility is going to come down as a package. You've got that going against you. However, you've got the difference in the volatility you bought versus the volatility you sold going for you, and the hope is that that will overcome the volatility just of the whole trade going lower. And the other thing you have is that the delta of the month, the closer month that you're selling, is going to be a little bit more sensitive than the farther out month, and thus, if you get a huge move either way, it's going to knock out your winnings, because if that strike is not in any way significant, then the spread between the months is going to be very close to zero, and thus you're not going to make money. But the reason I like the trade is I was only paying 50 cents. So in my mind, the most I can lose is 50 cents. So you do the trade 10 times, that's $500. You do the trade 100 times, that's $5,000. The second thing is I try to envision what these premiums would be after, and if one was $3.50 and the other is $3, well, that's probably going to come in quite a bit. It might be like after, it might be like one is $2 and the other is $1.50, or one is, you've got that $3 of room. Now, the higher those two premiums were, if one was like, the ICPT spread I did before, it was like one was 35 and the other, the option premium was $35 and the other was 33, and so you knew. If one's 35 and the other is 33 and you're buying the whole thing for like 50 cents, then you have a lot more chance that those two are going to be, the relationship's going to be wider than 50 cents. But if you've got, one option that's $1 and the other is 50 cents to start with, and you're anticipating volatility coming in, there's not a lot of movement there. So I put the spread on, I paid 50 cents for it. Everything sort of happened perfectly in that, by the time the stock opened, it was only up like $6-7. It started to fade back down. It was only up like $5 pretty soon. And I saw that basically my spread that I bought for 50 cents had almost doubled in value, and I just offered it immediately on the open, and I got filled at 94 cents. So it was turned out to be a great overnight little trade. The good news about that kind of trade is that it has a lot less risk than like taking a directional play or something like that. And the most you can lose is that $500 or that 50 cents per contract. Now, when the options are $3 and $3.50, then you know that you're not going to get that much out of it. But it did turn out to be a decent trade, and a lot of it has to do with picking the right strike and the right months to trade against each other. And you need there to be a differential between the months where you're actually buying a lower vol and selling a higher vol. It needs to be enough of a dollar of dollars in premium difference to make that worth your while. And I feel very comfortable paying 50 cents for anything when I know the most I can lose is 50 cents. So that worked out great. And the other trade I did this week, which was to re-enter KNDI trade. Now, this is a Chinese electric car company stock, and this is a basic, simple back spread. By that, I mean I'm essentially buying options and turning them into sort of straddles, and the play is that I'm going to hedge delta neutral, and I just want candy to move around. If it may not move for a couple of days, but then if it gaps up $1 or so, that's awesome. My decay is very small. The worst thing that can happen on this trade is that I slowly bleed, lose a teeny, maybe lose, 1/1000th of the value of my account every day. And that's the worst thing that can happen. I can get out of the trade if I don't like it, but it has got all upside and very little downside. And when I look at Candy, the reason I put this trade on is just when I look at the stock and I read the news stories, it just doesn't seem like the stock is going to stay right here where it is. And I'll just pull up the chart quickly. But if we back it out to a year chart, it's gapped, it's gapped up here to this higher level. And the news that made it gap up was that Candy had been authorized to sell 2 cars in the United States. And I think it's a car company that actually makes a real product. It's not just like a like by the seat of your pants biotech company that has an idea. It's got actually stuff that it sells, cars, and it's a real product, a real company. And it gapped up here, then it made another big move, then it moved back down, and I could easily see it going right back down to 6. I could see it moving higher, but it just doesn't seem to me like it's just going to sit here and rot. But if it does, then I'll lose a teeny tiny bit of money per day. I can live with that. In the meantime, I am noticeably not playing UVXY because I want to look for a pop to jump onto that one. Many times vol's been, vol's lower than it has been in a while pretty much. The VIX 1357. And yes, we are in contango, so this thing is decaying slowly. And yes, I do anticipate it making it through the all-time low of 35 and change sometime this summer. But in the meantime, I think that there's much more risk to the upside than reward to the downside for the moment in this issue. I could see it easily spiking on some sort of weird news. For those of you who've been riding it down the whole way, congratulations. I think it will continue to move slowly down. But for me right now, I would hate for it to happen that I short it right here and then it spikes again. And I short the bottom. And I've done that before in UVXY where everything looks great. You jump on and all it takes is some news story or something that pops. Much better to at least, now this might not make a huge difference in a big spike, but much better to wait until you get a day. A couple days last week where it was up $1, $2, $3. Much better to wait until a situation like that to hop on to a short, in my humble opinion. Anyway, thanks for watching. A lot of stuff going on with the channel. I did release for your Patreon people an update for you to read on Patreon about what's going on behind the scenes here. But I'm excited about what's going on behind the scenes, and I'm very hopeful that it will translate into better quality for all of you. Thanks for watching. Please spread me around. I want to increase those views. I want to get in front of people. More people I can get in front of, the better stuff I can bring you. So let's do this here, folks. All right. And more importantly than anything, I want you to make money this week. I love getting those notices that somebody made money out there. I think that's really awesome. Fight the power. All these Jason Bond. I'm so sick of seeing those ads. Jason Bond and the other guy, Raging Bull. And it's like, anytime you pull up someone's website and it's all these little things trying to get you to click this or that or buy this or that, there's a problem. I did actually check out part of that Raging Bull website, and there were definite things in the guy's options theory that are completely wrong. He wrote this thing: the best options to buy to capture the movement of the stock are at the money options. I was like, I thought that was in the money options were more like stock. According to him, it's at the money options. So not quite sure where he got his theory from, but I know that those guys are spending a fortune trying to market this stuff. So obviously they're spending a fortune because they're thinking they're going to make a fortune off of you. So don't let them do that, folks. Learn by yourself. Learn from people like me that aren't charging you an arm and a leg. And let's make some money. Let's not give it away to people. Let's make money. That's our goal. Thanks. Bye.